Afternoon, everyone. I welcome you all in our income tax class. So, namaskar, sat sri akal, good afternoon, vanakkam, kem cho, etc. So, I hope you all are doing well and studying for your examination that is going to be held in May 2025. And to fulfill your dream, of course, that's to become a chartered accountant as soon as possible. So, थोड़ी सर्दियां आ गई हैं, of course, आपको देखकर मुझे लग ही रहा होगा। आई गेस आप लोगों की अभी थोड़ी सी विंटर स्टार्ट हो गई होंगी तो ओके जस्ट टेक केयर ऑफ योरसेल्फ एंड स्टडी रियली हार्ड फॉर योर गोल सो विस्मिता गुड आफ्टरनून नितिन गुड आफ्टरनून नीरू गुड आफ्टरनून प्रणव गुड आफ्टरनून प्रीति हार्दिक संजय रागिनी बी साई किरण मानवी तंबेश्वरी जिनकी अजय सूर्य good afternoon to everyone. So today is our last session of capital gain, and we are going to cover the exemption section 54F, an example from that exemption because that is really a different kind of example, and that is very important for your examination also because this is the only case in their proportionate exemption is there. So you must have remembered that in all exemptions, section 54, 54B, D, EC, and F, only 54F has a special kind of formula we need to utilize. That is original capital gain upon net sale consideration for calculation of exemption, for taxability of misutilized amount, for taxability of unutilized amount. So that kind of question is different, slightly different from other exemptions. So we are going to solve an example from that. Then we will discuss section 55A, that is valuation by a valuation officer. And then we have to discuss a very interesting, complicated, and important topic, and that is calculation of tax on capital gain. And let me tell you, I don't remember last time when I prepared this kind of diagram. It's really very complicated. So, and I used to believe that the provisions, if you are going to read for applicability of tax rate in case of capital gain before 23rd of July and after, and we have short term, we have long term, we have short term 111A, we have long term 112, 112A, then for non-resident, we have separate provisions of that TTBR. For that, a separate tax rate is going to be applicable. So there are multiple provisions. And let me tell you very honestly, like I don't remember last time when I make this kind of diagram because in mostly cases I have already prepared the diagrams for each and every topic, and if there is any amendment in any topic, so I just need to update that diagram or chart presentation for assessment year, for change of assessment year cases. So this is the, I guess, like from last 6 or 7 years, this is the first time I prepared a completely new chart, new diagram, and I have to make multiple diagrams also to make the provision that easy that you can understand how to applicable in the examination. In the last session, I have shown you that I have physically prepared this diagram, and then after that, I just make that diagram on the Microsoft Word, of course, on computer readable media. And then in today's morning, I realized that still it is complicated because I have explained the diagram from the theoretical provision into the chart form. But I personally felt that this won't help you to solve a question. If you try to solve a question, even after this diagram, what I have prepared, you might feel little confused that in which case we have to apply which rate. So from today's morning, I also prepared two more diagram to just filter the provisions of that chart. So technically we are going to see the main diagram from the theoretical provision and then the sub diagram to understand that main diagram, that how to applicable the rates for a question perspective. Because to learn provision from that diagram, that is easy. But I believe that that was not going to help in the examination that much to solve the questions which are going to be asked in the question paper. So I had to prepare two more diagram to filter the main diagram. So you will see how much effort I have put to make these kind of diagram, and I really felt very good because that is really going to help you to understand the provisions of tax rate applicability in case of capital gain provisions. Okay, so this is going to be A very interesting class. But before that, as usual, we are going to share the thought for the day. And this is our today's thought for the day. Okay, Nancy, good afternoon. So life has two rules, never quit. And the rule number two is always remember rule number one. So it's a very interesting saying, which I generally or used to tell the students that if you want leave CA course, then CA will not leave you. So if you are determinate, if you are focused, if you are sure that you are going to complete this course, then trust me, you will be able to complete this course. So you should not quit whatever your goal, whatever purpose you have focused from this in this course. And always remember that you have to remember rule number one, and that is again never quit. Okay, so we have to start our class. Let's discuss with the previous provision. We are also going to discuss today the test your knowledge questions and MCQs also. So we have a lot to cover, and of course very interesting things going to be discussed in today's class. So we have gone through with all these things, and here is a special question from section 54F, and you have to understand the provisions, and you will understand why we are specifically solving a question that section 54F is there, because there is a very interesting concept in case of section 54F. And let me tell you what is exactly the purpose of solving a question from section 54F. Now, section 54F applicability. The section 54F applicability is if there is any long-term capital gain other than the residential house. Remember, other than the residential house. And you have to purchase a residential house or construction of a new residential house. So that was the applicability. So there could be any other long-term capital asset, any other long-term capital gain except residential house. So now there could be a problem. And what is exactly going to be the problem which we need to solve? It is something like this. Suppose Mr. A transfer his jewelry and shares and land, all three items in previous year 24-25. Clear? Now we have sales consideration for jewelry was supposed 21 lakh. For shares, it was 51 lakh. For land, it was suppose 101 lakh. Okay, now expenses on transfer, like brokerage, etc. Suppose 1 lakh each in all cases. So there would be net sale consideration. It should be 20, then 50, and then 100. Clear? Now, after transferring these assets, suppose now Mr. A wants to purchase a new residential house. He wants to invest the amount of these capital gain for purchasing a new residential house. Now, here's a very simple question from my point of view. But before that, suppose there is index cost of acquisition in these cases or cost of acquisition. Suppose in this case it's 15 lakh. Suppose in this case it's 22 lakh. Suppose in this case it's 70 lakh. So there will be long-term capital gain in all the three cases. This is 5 lakh. Now we have 28 lakh and we have 30 lakh. So we have long-term capital gains out of these three capital asset. Now my question is this: out of these three assets, what is the maximum amount Mr. A can invest to purchase a residential house? What is the maximum amount he can invest to purchase a residential house from these three transactions? Option 1, 170 lakh. Option 2, 63 lakh. So what is the maximum amount of investment can Mr. A done out of these three transactions to purchase a new residential house? So let's see what is the answer. It could be 63 or it could be 170. So what could be the correct answer? 170 or 63? So Pur saying 63, Tambeshwari saying 63, Ajay Surya, how much he want? No, how could be this answer? How much he want? I'm asking how maximum amount what he can invest. Hardik is saying 63, Malu is saying 63, Anjali is saying 63, Manvi is also saying 60. Nobody is saying 170 lakh. Okay, Veda is saying 170. Any other? It's a very simple mathematical question. There is nothing related to capital gain or income tax or with any other concept. It's just a proper simple mathematics question. It's a very layman question. And I guess more than 90% students say 63 lakh, which is a wrong answer. Okay, this is a wrong answer. It would be 170 lakh rupees. Out of these three, Ajay Surya, what are you saying? Out of these three transactions, how can he invest 10 CR? He should have money to invest 10 CR. Na? Maximum he has only 170 lakhs. So how can he invest 110 CR or 5 CR? Please be focused. What we are asking, kindly you have to focus what is the question. And that is very simple question. That's what I asked this question. So 63 is the student 63 is a profit he earned out of these transactions. But we can invest not the profit, but the consideration we have. So in Mr. A hands, he received total 170 lakh rupees as a consideration. So maximum investment could be 170 lakh. Why it should be 63? Okay, fine. Let's change the question. Okay. Suppose I purchased a pen of rupees 10. Okay. And after some time, I transfer this pen to someone else for rupees 14 rupees. So I earn a net profit 4 rupees. Now I want to ask, I want to buy a new pen. So how much maximum amount I can invest to buy a new pen? 14 rupees or 4 rupees? Of course 14. So whatever we have in our pocket, that is the amount now we can invest. Why are you answering the profit part? Profit is something different. Technically, he received 170 lakh rupees. That's why I have separately shown you the net sale consideration part. The sale consideration could not be, it could not be 173. Even if somebody asks option, we have three options 173, 170, or 63. Still, it would be 170 because we received total 170 lakh. So now you got it. What is the maximum amount he can invest to purchase the residential house? That is maximum 170 lakh rupees. Is there any confusion in this now? I hope no. So suppose he could invest maximum 170 lakh, but suppose he invests 160 lakh to purchase a new residential house. He invests 160 lakh within certain time, or he invests in the government scheme, whatever is the provisions are. So technically, he invests 160 lakh out of all the three transaction he has made. Total 160 lakh has been invested to purchase a new residential house. Now the problem is this, that these transactions fulfill section 54F concept, that jewelry investment, that other than residential house, and jewelry investment has been made in a residential house. So this jewelry capital gain will say that I want to claim section 54F benefit. And yes, that jewelry fulfill these conditions. Shares also demand the same, that my consideration also has been used in 160 lakh for the purchase of residential house. So I also want section 54F exemption, of course, correct. And so on also in case of land. So all these three are eligible to claim the exemption of section 54F. But the problem is this, which should be given the priority? Who should be the first one to claim the exemption? Who should be the second one? And who should be the third one? You can provide this exemption to anyone in any order if we could provide this exemption either first to jewelry, then shares or land, or vice versa, or anyway. It wouldn't affect our answer if there was not the investment proportionate formula for the purpose of exemption. If there would be any other section like section 54D, etc., there is no specific formula. Proportionate formula is not there. So you can invest in any order or any way. It does not affect your answer. But because section 54F say we have exemption will be provided on the basis of this formula, original capital gain upon net sale consideration into investment amount. So now we have to find out the order for give the exemption, because all these three are eligible to claim the exemption, and the investment could be maximum 170 lakh. So if the total investment has been done 170 lakh for purchase of a residential house, again there could not be any problem. But because the consideration which has been invested is less than that, so we have to find out which should be given the priority first, because it will affect your answer. So for that purpose, under section 54F only, if this is a separate section other than section 54F, suppose there is section 54 EC, we have transferred these all securities and invested in the government, NHI, etc. bonds, then you can provide exemption to anyone in first, second, or third in any order. That won't affect your answer. But because section 54F having a special proportionate exemption, so now for this purpose we have to find out the ranking between these three assets. Who should be provided first number of exemption, then second, and then third. For the purpose of finding out the ranking, again this formula is going to help. The formula would be, for the purpose of ranking, would be same. Original capital gain upon net sale consideration into 100. You just need to multiply 100. So that will provide you the percentage wise investment proportionate. So if we apply this, then in first case, that is 25%. Original cap gain is 5. Net sale consideration is 20 into 100. So that is 25%. In the second case, 28 divided by 50 into 100. So it is 56% proportionate benefit. And in third case, it would be 30 divided by, that is 30%. So what is this percentage denote? This percentage denote if you invest 1 rupees from jewelry for the purpose of investment, 25% of 1 rupees is going to be exempted. So investing 1 rupees will exempt your 25% of capital gain only. So after investing 1 rupees, how much capital gain exemption you will get? Only 25 paisa. If you invest 1 rupees from the shares investment, you will get 0.55. That means 0.56 paisa benefit from the capital gain exemption. And if you invest 1 rupees from the consideration of land, you will get the 30% exemption of the capital gain. So against 1 rupees, 30 paisa will be exempted in this case. 1 rupees, 56 paisa is going to be exempted in this case, and 25 paisa in this case. So the maximum benefit would be in firstly investment of shares proceeding into residential house. Then second, we will provide the benefit to land, and the third would be the jewelry. So the amount of cap gain does not affect it. The maximum cap gain is in this case, but it score the second ranking. So we have to see the proportionate benefit, return on investment sort of. So the benefit is maximum in case of share. So now we have decided to provide the section 54 exemption in this order. Now what is the formula for the exemption purpose? Original capital gain. So if we provide the benefit first of all to shares, so the formula would be original capital gain upon net sale consideration and multiply by the investment amount. So how much is the investment amount in this case I should write over here? Who will tell? What should be the investment amount I should write, or I should multiply to find out the solution? Hardik is saying 160, Apurva is saying 170. No. 160, 170 is wrong answer. No. You should understand how much maximum share consideration portion could be in this 160 lakh. How can you invest 160 lakh when you have consideration maximum 50? So we need to find out how much maximum investment is from consideration of shares could be here. 160 is not the consideration of shares only. It is the aggregate investment. So that cannot exceed the net sale consideration value. So from shares, we can invest maximum 50. So that means the exemption would be 28 lakhs. So 28 lakh was the capital gain. 28 lakh is the exemption. So taxability in this case is nil. Now out of 160 lakh investment, we have utilized 50 lakh consideration from shares. So the remaining is just now 110 lakh rupees. Now the second number belongs to land. So again the same formula we need to apply. Capital gain upon net sale consideration. Now as a smart student, tell me how much amount of investment maximum we can use from land sale consideration. If you write 160 again, how it's possible? So that could be maximum 100. So this value cannot exceed this value automatically. So that means 30 lakh rupees exemption from land capital gain, 30 lakh rupees gain, 30 lakh exemption. So taxability would be nil. Don't think that in this kind of cases, so always cap gain would be nil. No, it won't. Now you can see 100 has been utilized from this 160 from the land sale consideration. So balance investment is just 10 lakh rupees. And that would be from jewelry part. So now capital gain would be taxable in this case. Original capital gain upon net sale consideration. So the maximum consideration could be 20, but we just invested 160 lakh. We have consideration of 170, out of which we just invest 160. So technically, the last investment is only 10 lakh from this consideration, not 20. So there would be, this value would be always balancing figure, which has been remaining after deducting this. So this is very important from your examination point of view. You have to deduct one by one the sale consideration. If you won't do this, so you might be writing over here 20 lakh rupees, but it should be 10 lakhs. That would be, your solution would be wrong in this case. So in a working note part, you have to deduct the investment as soon as you are using it in the exemption of other asset. So now the balance is 10. So technically, we have the exemption of 2.5 lakhs. So now the taxable long-term capital gain would be 2.5 lakhs. Clear? So now you can see the taxable cap gain would be 2.5 lakh rupees out of the whole capital gain of 63 lakh rupees. If you will change the ranking, suppose you want to provide jewelry number 1 ranking, shares number 2, and land number 3, or in any other order. If you will change this order, the resulting capital gain tax would be always higher. You can try this. After the class, you can try this, that you want to give the first priority to land, then shares, then jewelry, any other order you can try. The capital gain would be higher than 2.5 lakh in all these cases. So what I am just trying to explain, that if under section 54F question is in examination is there, and there are multiple asset has been transferred, and all are eligible to claim the exemption under section 54F, then you have to first of all do the ranking. This is the first part. You have to find the ranking. After ranking, you have to utilize the consideration amount which has been used as investment. And always remember, you have to follow this thing, because if you won't follow this, you might be wrongly taking 20 lakh rupees in this case also, and that would result in a capital gain 0. And that would might result a result marks also 0 in this case. So please remember this kind of questions. For examination purpose, it's really, really important. Okay. So I've also made a solved question here, and we are having 4 assets over here in the same case. Section 54F, you can say jewelry, shares, capital index bond, and land we have. We have the net sale consideration in the questions and capital gain also now. And he invests 540 lakh rupees to purchase a new residential house. Calculate capital gain in this case. So we have done the ranking. Ranking is 1 is there, second is there, third is there, and fourth ranking is there as per the formula. Then we have the investment. First of all, we have provided the benefit to this, then this, then this, then the third and fourth. In the fourth case, you will see the balancing figure will be over here. So the balance amount that is going to be taxable is 13 lakh rupees. So you can try this example without seeing the solution. And if your answer is 13 lakh rupees, so that means you have understood the provision. If your answer does not match, then kindly see the solution. You will find your mistake. Okay. So that was the thing we need to discuss. Section 54F. That's why I told you that it is a very, very interesting section for the purpose of examination point of view. Now, reference to valuation officer section 55A. It's a very simple provision. Theoretically, it's nothing complicated. It's a self-explained, of course, section 55A, and it says when there is any confusion regarding the fair market value. If the department thinks the fair market value which has been used by the assessee might be not correct, so that value could be asked to revalued by a valuation officer in certain cases. So section 55A provides the assessing officer may refer the valuation of a capital asset to a valuation officer in the following circumstances with a view to ascertaining the correct fair market value of the capital asset. The main provision in this is when we can do so, there should be certain conditions should be satisfied. Only in those cases, the case could be referred to the valuation officer, and the provision says if the assessing officer is of the opinion that the fair market value of the asset exceed the value of the asset as claimed by the assessee. So whatever fair market value claimed by assessee, an assessing officer thinks that any one of this condition, if fulfilled, then we can go for valuation officer. That the difference between the assessing officer value or the FMV is more than 25,000 or exceeding 15% of the value claimed by the assessee. So you will understand with the help of these three examples, very, very simple example. Suppose value claimed by assessee is 1 lakh. But assessing officer thinks that it is 1,20,000. So one of these conditions should be satisfied. Either the difference is exceeding 25,000 or 15%. So you can see the amount difference is not 25,000 in this case, but the 15% of this value, the FMV has been exceeded. So 15% condition has been fulfilled. So this value can be referred to the valuation officer. Now second case, 5 lakh is the value claimed, FMV is 540. So FMV and this value difference exceeding 25,000 amount differences. So reference can be made to the valuation officer. The third case, the value claimed is 1 lakh. The FMV in the opinion of valuation officer is 1,12,000. And now you can see it does not exceeding 15% and does not exceed 25,000 condition also. So none of this condition has been satisfied. So this case cannot be referred to the valuation officer. Okay, theoretical provision, you can go through this. So now what we were waiting for is in front of us, and that is calculation of tax part. And we will solve it in that filter basis, like filter kind of study. First of all, we will read the whole procedure, whole theoretical part. The rates need to be applicable, etc. Then we will shift it to the diagram part, which will explain all these provision in a diagram or chart presentation. And then we will see those charts which I have prepared for the purpose of examination point of view. So that would be really going to help you to solve a question. Otherwise, definitely it's going to be very complicated and you will realize it. Why I'm going to read you all these provisions? Because you will realize the power of diagram and chart that yes, these provision can be easily understood if we are going to read these provision with the help of diagram and chart. So first of all, there's a performer for computation of income under the head capital gain. Let me tell you, if there is any confusion in chart or any rate, kindly refer to these provision which has been copied from your study material. So of course, they are always correct. There could be a printing mistake. There could be a confusion. If you have any confusion with the provisions of chart, diagram, etc., please refer to the detailed provisions of these study material provision. Of course, they are all correct and will prevail on everything. So first of all, there's a performer for computing the capital gain. So these are not tax rate provision. These are the performer we have already discussed. And this is a performer how to calculate short-term capital gain. This is from your study material, of course. So we all know now that we need to take the sale consideration, deduct the expense on transfer, no deduction for STT, security transaction taxes. So we will have our net sale consideration. Then need to deduct the cost of acquisition and cost of improvement that will result in our short-term capital gain. Only two exemption would be applicable in case of short-term capital gain, section 54B or 54D. In all other cases, there should be long-term capital gain in this case. Clear? So that was short-term capital gain calculation. Now we are having long-term capital gain calculation, and we know in case of long-term capital gain, we have two kind of provision before 23rd of July or on or after 23rd of July. So before 23rd of July, we have the benefit of indexation, and after on or after 23rd of July, we have the benefit of indexation only in case of land and building from an individual HUF who is resident. And that is also that calculation will be for the purpose of calculating tax only. For the purpose of GTI, again, we will not provide any kind of indexation, even in case of land and building from an individual or HUF, those are resident in India. So before 23rd of July, what was the concept? That we need to take the full value of consideration, expenditure, net sale consideration. Now, if it is a long-term capital asset, of course, then we have to do the indexation concept. But again, up to before 23rd July also, there were certain long-term capital asset on which indexation was not applicable. We have discussed those concepts in the notes also. In case of debenture and bonds, there was no concept of indexation. In case of depreciable asset, there is no concept of indexation. In case of slum sale, there is no concept of indexation, whether it's long-term, etc. So on those assets on which indexation is going to be applicable, only in those cases, index cost of acquisition is going to be calculated if it is before 23rd of July. So for the formula of index cost of acquisition, we have already gone through with those concepts, and index cost of improvement also. After that, we will have our long-term capital gain. And for the purpose of long-term capital gain, all exemptions are applicable. All those 5 exemptions are applicable for long-term capital gain. For short-term, only there is section 54B and 54D is applicable. Clear? That is before 23rd of July. Now, what happened after 23rd of July? After 23rd of July, it would be same as in case of short-term capital gain. The nature would be long-term, but the concept, the solution part would be exactly same as short-term capital gain. You can see the net sale consideration, cost, and index cost of acquisition. So if any one of you is thinking that we have discussed that in case of individual HUF resident, and if they are transferring building, land, or any immovable property, so indexation would be applicable. Yes, indexation would be applicable. We have discussed this also earlier. But in case of individual HUF resident transfer land and building on or after 23rd of July 24, in the GTI calculation, this would remain the cost of acquisition and cost of improvement. But when we will calculate the tax, then we apply the index cost of acquisition or index cost of improvement in this case. And if due to this, we have to calculate the tax at the rate of 20%. And if these provision, we need to calculate tax at the rate of 12.5%, and whichever is lower or beneficial to the assessee need to be taken. So please keep this provision in the mind that the calculation in the GTI format will always be without indexation on or after 23rd of July, even in case of land building of an individual, etc. This benefit of indexation could be claimed only if there is a calculation of tax provision we are going to solve. So if the question asks you to calculate capital gain on only your total income, not the tax liability, then you won't apply the index cost of acquisition provision, even in case of individual HUF resident. Understood? So that was the format, how we need to solve. Now the rate of taxes is here in front of you. So we are going to read it out because kaise bhi kar lo, it would be really difficult to understand or to learn these tax rate applicability by reading these provisions like this. So we have to go to the chart or diagram part. But before that, we need to read the provision from the sections. So section 111A. Section 111A deals with short-term capital gain on certain specified assets. Only on equity shares, units of equity-oriented fund on which STT has been paid. So you might remember that when we discussed section 112A long-term capital gain, in which there were exemption of section 1,25,000. And to find out the cost, there was a special provision. And at that time, we have discussed those asset on which section 112A applicable. If they are long term, they will fall under section 112A. If they are short term, they would be under section 111A. So that is again 111A. So if these assets are short term, the provision would be taxability under 111A. If these are long term, the taxability would be under section 112A. So what are those assets? Listed equity shares, units of equity oriented fund, and units of business trust. So what is business trust? That is going to be explained at final level. STT should have been paid on such sale. So security transaction tax need to be paid on these transactions. Okay? At a time of sale. So if these short-term capital gain, if this short-term capital gain arise before 23rd of July, the tax rate would be 15%. And if it is on or after 23rd of July, the rate has been extended to 20%. Clear? If these transaction has been undertaken under International Financial Service Center, STCG arising from transaction undertaken in foreign currency on a recognized stock exchange under an IFSC. So if these assets which has been explained above, if the transaction has been carried in foreign currency under a recognized stock exchange and under an international financial service center, even STT paid or not does not matter. In this case also, same provision would be applicable, 20% rate or 15%. Up to before 23rd of July, it would be 15%. On or after 23rd of July, it would be 20%. So if these assets has been transferred in foreign currency in an international financial service center or with a recognized stock exchange, then exactly the same rate would be applicable. Okay. One by one, you will feel the complexity of this chart. Short-term capital gain arising from other short-term capital asset would be chargeable as normal rate of tax. Normal rate of tax means person-wise. Slab rate-wise, if it is a company, then the person-wise. If it's a partnership firm, then it would be as person-wise. We will discuss each and everything in a diagram, do not worry. Now the long-term capital gain concept emerged, and it says long-term cap gain would be as per section 112A security. Again, those security, if those are short-term, they were section 111A applicable. And if these are long-term, then section 112A applicable. Now there is an exemption of 1,25,000. If it's up to 1,25,000, there would not be any taxability. So if securities, those fall under section 112A exceeding 1,25,000 rupees long-term capital gain and transferred before 23rd of July, the rate of tax would be 10% and on or after it's 12.5% on the transfer of following long-term capital asset. Exactly same listed units of equity oriented fund and business trust if STT has been paid on transfer of such units. Total exemption is 1,25,000. It is an aggregate, whether it's before 23rd of July or after 23rd of July. The total amount of gain could not be exempted more than 1,25,000. Again, same condition as section 111A. If this security has been transferred in an international financial service center from a recognized stock exchange Again, the rate would be same 10% or 12.5%, whether STT has been paid or not paid. So you might be thinking, what is difficult in this? Exactly same things we are repeating. Let's wait. And without the benefit of currency exchange or indexation, there would not be any benefit of indexation or currency exchange in case of these security. Remember the currency exchange benefit, that TTBR and TTSR concept we have gone through. So those benefit is not available in this case. No indexation because section 112A, there could not be any indexation if section 112A applicable. No indexation, and even if they are transferred at foreign currency, the benefit of TTBR, TTSR you cannot claim. The rate would be again same 10% or 12.5%. So those were section 112A asset. Now the other long-term capital asset, those has been covered section 112. If transfer take place before 23rd of July, so unlisted securities or shares of a closely held company. Closely held company means those company in which public are not substantially interested. Those we call closely held company. So if assessee is a non-corporate, non-resident, normally we can say non-resident assessee other than a company. Or if it is a foreign company, whether resident or not resident, then the applicability of it is 10% without the benefit of indexation and foreign currency. If you are other assessee, in this case 20% with indexation, tax rate would be applicable. Okay. If these are listed security, do not worry. You might be feeling that कुछ समझ नहीं आ रहा, हो क्या रहा है? मुझे भी नहीं आया था जब मैं अभी पहली बार इसको पढ़ रहा था, because this 23rd of July makes everything so complicated. So just stay with me. By the end of the lecture, you will understand, okay, this is going to be happen. So first of all, we have to read the provision. So nobody will try to read the chart directly. When I will share the chart, do not do this, that for the purpose of examination, you are just reading the chart and you are just applying the provision like that. No, you have to read these provisions first. So only if you have read these provision first, then you will able to connect in the chart that, okay, this point has been discussed in the provision at that part. And if even there is any confusion, so you can relate, okay, from this point of chart, I need to find the provision in these provision, what is correct or what is misprinting, etc. So please, nobody will take a shortcut. And after sharing chart, if you are thinking that you are not going to revise these provision from the theoretical part, please do not do so. Okay. So that was for unlisted security or shares of a closely held company. Now listed security or zero coupon bonds. If before 23rd of July you have transferred, then you have to calculate again the gain twice, 10% tax without indexation concept and 20% tax with indexation effect. As same in case of land and building, we are seeing on or after 23rd of July. On or after 23rd of July, there was also a provision like this before 23rd of July. In case of listed security or a zero coupon bond, you have to calculate tax twice. Once without indexation, and the tax rate would be 10%. And one with indexation, the tax rate would be 20%, whichever is more beneficial to the assessee. That means lower would be the tax rate. On any other asset except section 112A. Why except section 112A? Because that has been discussed earlier. So any other asset like building, land, jewelry, any other asset except these two, the rate of long-term capital gain was 20% with indexation benefit. Any other cases. So that was till 23rd of July 2024. Now things becomes more interesting. If transfer take place on or after 23rd of July 2024, now building portion will go separately need to be solved. And it says, if land or building or both, if acquired before 23rd of July. So we are talking about those land and building, those has been acquired before 23rd of July and transferred on or after 23rd of July 24. So do not get confused at why that is before. Before means that has been purchased in suppose 2022, 2021, 2001, 2004 or 1997. Any building which has been purchased before this date but transferred on or after 23rd of July. This concept will be applicable if you are an individual HUF being a resident. Then 12.5% you have to calculate once without indexation and 20% with indexation. Whichever is more beneficial to the SASI, that means whichever is lower. For other SSCs, for any other SSC, the rate would be 12.5% in case of land or building without indexation. Now, please watch this case. This is also talking about again land or building or both if acquired on or after 23rd of July. So this is those land and building has been purchased before 23rd of July and transferred on or after 23rd of July. So for that only the benefit of indexation and without indexation has been provided to an individual or HUF. But if there is any land and building which has been purchased on or after 23rd of July, suppose we purchase a land and building on 1st August 2024 and transferred on or after this date, then the indexation advantage is not there. So this indexation advantage is only for those long-term capital asset, land and building, which has been purchased or acquired before 23rd of July, but transfer on or after 23rd of July. Any other asset means except land and building, whether purchased before 23rd of July, whether purchased on or after 23rd of July, does not matter. They should just transfer on or after 23rd of July. So the building has been divided into two categories. Even transferred on or after 23rd of July, but that has been separated into two categories. Those building acquired before 23rd of July and transfer on or after 23rd of July, having the benefit of with indexation, without indexation. Any building which has been acquired after 23rd of July or any other asset like jewelry, whatever it is, any other asset, if that has been transferred on or after 23rd of July, the provision would remain the same for all. That is 12.5% without indexation. In case of a non-resident long-term cap gain on transfer of unlisted security or shares of a closely held company would be taxable at the rate 12.5% without indexation and foreign currency fluctuations. Kasak is saying correct, of course. Sir, if land and building after 23rd July for taxation, will it not be short-term capital asset? Absolutely correct, Kasak. But this provision has been made for future years. Of course, if you have purchased a land and building on or after 23rd of July 24, and if you transferred before end of this financial year, before 31st March 25 for the purpose of your examination, it would be a short-term capital asset. This provision would not be applicable. But income tax make this amendment by thinking that what will happen in future. So if any land and building has been purchased on or after 23rd of July and it would transfer after 3 or 5 years, after 24 months, suppose in 2027, then they cannot take the benefit of this indexation because indexation benefit is only for those land and building which has been purchased before this date. So you are absolutely right. If it is purchased in this year on or after 23rd of July, that would not form in the case of long-term capital asset. But this provision has been made keeping in mind the future prospect, what could it be? So from that point of view, it has been said that if it is purchased on or after 23rd of July, and if it becomes a long-term for future years, then rate would be 12.5. It has been transferred in the same year, it would be a part of other short-term capital gains. The law changes every year. Yes, if it does not change, then this provision would be like this. 20% rate, Kasak, why? If it is a short-term capital asset and it's a building, it would not fall under short-term shares category. So that would form under normal rate of taxability. This is Kasak. If that building, if it's purchased on or after 23rd of July 24 and sold before 31st March 25, it would be a short-term capital asset. And tax rate would not be 20%. No, it would be like this point of view. Other short-term would be taxable at normal rate of tax. Okay. Fine. Do not worry. अभी और complication होने वाले हैं. अभी रुक जाओ. Now there are certain clarification or notes. In case of a resident individual or a Hindu undivided family, HUF, the long-term capital gain taxable under section 112, 112A and short-term 111A shall be reduced by the unexhausted basic exemption limit and the balance shall be subject to tax. In case of resident individual and HUF, you have seen that we have basic exemption limit. That is 2,50,000 an optional tax scheme, 3 lakh, 5 lakh. In case of default tax regime, it is again 3 lakh rupees. So if this basic exemption limit needs to be used, first of all, from other income category. Other income means other than these long-term, short-term gain, etc. If the limit balance value has been left, then the balance amount you can utilize for the purpose of taking exemption from 111A, 112A and 112. So that is allowable. Clear? Next, in case of bonds or debenture, we have discussed this provision, I guess in section 50AA. In respect of bonds or debenture, whether listed or unlisted, transferred before 23rd of July, the resultant gain would be either long-term or short-term. But any bonds or debenture, if they are redeemed on or after 23rd of July 24, they will always be considered as short-term regardless of their holding period. Indexation benefit, even you cannot claim in case of bonds or debenture, even if before 23rd of July or on or after 23rd of July. Very interesting point number 3 also, the deduction chapter, section 80C to 80U. There are certain deductions that you can claim from your gross total income. But you cannot claim any deduction from any long-term or short-term capital gain income out of section 112 or 112A or short-term 111A. So deductions also not allowable from this. Again, the rebate under section 87A is not available in case of tax payable on long-term capital gain under section 112A. The rebate of amount what we can claim cannot be available from long-term capital gain under section 112A. In the case this is related to your surcharge provision, what we have discussed in basic concept provision. Surcharge in case of default tax regime and optional tax regime. So these points you can understand if you still remember the provision of surcharge. Okay, you can go through surcharge provision and you will understand what these 2 points are trying to say. Now, period of holding again, just for your revision purpose, the provisions of this bonds and debenture. For this purpose, I again include this period of holding concept over here. So that bonds and debenture was talking about this note, what we already discussed. It is to be noted that as per section 50AA, there were certain assets, they will always be short-term capital gain. Units of specified mutual fund, market-linked debenture, and these are the bonds and debenture I was talking, which has been explained above. That if any unlisted bonds and debenture has been redeemed or matured on or after 23rd of July, it would always be short-term. If it has been redeemed before 23rd of July, then it will depend whether they were short-term capital asset or long-term capital asset. The rate of tax is still not completed. It's still in the process. Now they are again explaining those provisions, what we have seen above in detail, the applicability of rates. It says tax on short-term capital gain in respect of equity shares, units of an equity-oriented fund, or section 111A. Okay, student, what I will do, I will merge part 1 and part 2 of capital gain notes. I have not uploaded these part 2 notes. So what I will do, I will merge the capital gain full notes, part 1 and part 2. Because in part 1, there was a section I have to omit it, what we have discussed in, I guess, buyback of shares. So I will upload the new notes without that applicability of that provision. So you can upload these notes, which will be part 1 and part 2 merged. So you will have the complete updated notes of part 1 as well as part 2 for the purpose of your revision, etc. Okay. And even you can use the part 1 earlier uploaded, but there was only one provision I asked you to rectify, that there is no tax liability upon domestic company in case of buyback of shares now. So again, the same provision is going to be explained in detail. This section provides, section 111A, we have discussed in case of equity share, units of business trust or unit of equity oriented fund. If the STT has been paid at the time of transfer, then the capital gain would be 15% before 23rd of July, on or after it's 20%. So why we are reading it again? Because it has been explained in detail over here. Again, if it is an international financial service center, again the same case, the rate would be 15 or 20, even STT not paid. Adjustment of unexhausted basic exemption limit. As we discussed, we can claim the benefit of our unexhausted exemption limit from section 111A, 112A, and 112 if you are a resident. Non-resident cannot use the unexhausted basic exemption limit. That has been explained. You can see over here. However, the benefit of availing the basic exemption limit is not available in the case of a non-resident. Again, deductions cannot be claimed under section 111A, 112A, or 112. Tax on long-term capital gain, explained in detail, where transfer take place before, unlisted security, etc., 10%, other SSE 20%. Listed zero coupon bonds, we have all gone through with all these provisions earlier. Important points to be remembered. We have discussed all these things, of course. Tax on long-term capital in section 112A, the exemption is 1,25,000. Then we have the rate is 10%. On or after 23rd of July, it's 12.5%. Again, the same provisions are over here. Unexhausted basic exemption limit can be utilized only in case of resident. Non-resident cannot take the benefit. Rebate cannot be claimed against 112A tax. Then we have illustration also to understand the solution, etc. So that we are going to discuss with test your knowledge questions, etc. So these were the provisions, and now we will move on to the diagram part or the chart part, and you will see how these provisions going to be summarized in chart form. So that is really going to help you to solve or understand the solution process of the question when it is going to be asked in the examination. Now, what will happen? Even if you are able to learn all those provisions, what we just discussed with you, if there is a numerical, you might be confused that in which case, which rate of tax I need to apply or how to solve a question. So that is really going to be difficult in the examination. For that purpose, we are going to see what is exemptions, what kind of exemption, what kind of basic exemption limit we can claim, or what tax rate we need to apply. Hardik is saying maximum surcharge in case of special income. Yes, it's 15%. That's why those provisions were saying regarding surcharge that in case of section 112, 111A or 112 income, the surcharge of 25% or 37% cannot be applicable. It has been explained in the surcharge rate provision. B. Sai Kumar is asking, sir, while availing this unexhausted limit of basic exemption for long-term cap gain, short-term cap gain, what about 87A exemption? Do not worry. We are going to understand all these provisions together one by one with the help of diagram. Okay, so now you will see the benefit of drawing diagram to understand all these provisions one by one. So on your screen, there is capital gain. First of all, the pro forma of capital gain calculation. I also convert that provision in the format part. Like there were two kinds of calculation. One was short-term capital gain. Very simple. Sale consideration, expense on transfer, net sale consideration, cost of acquisition, cost of improvement, short-term cap gain. We have only two exemptions over here. So that is very simplified form. You can understand how to calculate short-term capital gain. Now, for the purpose of long-term capital gain, we have two kinds of calculation: before 23rd of July and on or after 23rd of July. Before 23rd of July, we have the differences: index cost of acquisition and index cost of improvement. So that would result my long-term capital gain. We can claim all exemption if we satisfy the condition specified over there, and there would be long-term capital gain or loss. Loss could not be there after applicability of exemptions. On or after, now the index cost has been changed into cost of acquisition or cost of improvement. But in case of land or building or both, if transferred by individual HUF, those are resident. Indexation benefit will be provided in tax calculation. Remember, it would be provided in tax calculation, but not for GTI purpose, not for gross total income purpose. And for the tax purpose, with index, it would be 20%. Without index, it would be 12.5%, which is lower or most beneficial to the assessor. So that was the format part, very simple form. Now you can see the calculation of tax rates, whatever has been we have gone through with the provision part is trying to summarize over here. And after preparing this chart, I realized that yes, I have converted all the theoretical provision over here. So you can find it out that which gain is going to be taxable at which rate and what will be the consequences before 23rd of July and what has been changed on or after 23rd of July. Let me tell you, it's very, very, very complicated if you are going to read the provision with the help of the theoretical base. Once you will go through with the theoretical provision, and now if you'll go through with this diagram, you will really going to understand that what is different kind of taxability in long-term capital gain. But when I prepared this diagram, I realized you can see it's huge, multiple provision. After reading or preparing this diagram, I realized, I told you that I realized in the morning that being a student, it would be really difficult to solve a question with this help of this diagram. You would be able to understand the provision. You will be able to understand what kind of tax is going to be applied on which kind of gain. That would be able to understand. But still, I felt that from the point of view of a student, still you won't be able to solve a question only with these rates and these permutation and combination and the situation which has been explained in the diagram. So after that, this was the diagram, and this is the we can say clarification of diagram. After that, I have to prepare these two diagrams for the purpose of numerical solution practically. And this is the final outcome of the above diagram. So above diagram is to understand the rate structure in case of capital gain. But for the purpose of solving a numerical, you have to understand this diagram, which is for before 23rd of July. For resident, it separately I have prepared for all of you. And for non-resident SSC, the rates has been changed. So it has been separately made for you. So if in the question belongs to a resident before 23rd of July, you have to solve a question with the help of this part. And if it is on or after 23rd of July, and for a non-resident before 23rd of July, for non-resident, you have to find or you have to solve the question with the help of this diagram. And if it is on or after 23rd of July, then we have to follow this. 70 to 75% provisions are same. You might be thinking, my God, we have to learn so much of diagram. No, this diagram might be, you must be feeling that it's having so much of complications, so much parts, but 70-80%, they all are similar. Whether resident, non-resident, if you are able to understand the resident part of diagram, that means almost 70 to 80% we have understood the provision, how to apply. But the deduction problem, the basic exemption limit concept, the rebate applicability, I have actually include each and everything in these diagrams. But we will discuss these diagrams after understanding the provisions from this diagram. So this is calculation of tax for assessment year 25-26 on capital gain. Only capital gain. So either the gain would be first of all the short term or it could be long term. Calculation of tax for assessment year 25-26 on capital gain. So if that is a short-term capital gain, for the purpose of solution, you have to find it out. If it is a short-term capital gain, either it should be a 111A short-term capital gain. 111A means listed equity shares, units of equity-oriented fund, units of business trust on which STT has been paid on sale. So if you want to clarify, if you want to understand the provision detail, so that has been explained in the notes already. So you can go on section 111A and you can find it out, okay, what has been written over there. So you can correlate from that also. So I have explained each and everything with the section, so you can find it out easily in the detailed notes also. So if you have a short-term capital asset and if you earn a short-term capital gain, and if that is listed equity shares, units of equity oriented fund or units of business trust on which STT has been paid. So if it is before 23rd of July, the rate of tax would be 15%. That's it. If on or after 23rd of July, the rate of tax would be 20%. Now there was a concept of International Financial Service Center in which asset has been transferred in foreign currency and with recognized stock exchange. So that has been explained in point number 2 of short-term capital asset. Transaction in foreign currency on RSC in IFSC, even if no STT paid. The rates are same. You can only learn one rate. So for consolidate purpose, you can learn like this. If there is STCG under section 111A on listed securities, EOU or units of business trust, and in foreign currency, RSC, which has been in IFSC, then the gain would be taxable at 15% if it is before, and it would be 20% if it is after. So you need not to separately learn 111A. You can read together also. In the notes, it has been separately shown, but you can now see the rate of taxability is same. So why do I need to learn them separately? I can learn like this. If that is equity share, units of UTI, or units of EOF or business trust, STT paid. Or IFSC, recognized stock exchange, no STT paid. The rate would be same. Either it would be 15%, it would be 20%. Okay. So other short-term capital gain having normal rate of tax provision applicability as per person wise. Suppose there is a short-term capital gain on building. So what will happen? It would be taxable as your normal slab rate of tax. If you're an individual, if you are applying for default tax regime, so the 3 lakh, then 7 lakh, then the limit would be 10 lakh sort of rate range would be applicable. If it is an optional tax regime, then up to 2.5 lakh rupees exempted, then again 5% taxable, 20%. So that other short-term capital gain would form up your normal income, and it would be taxable at your slab rate or person-wise rate. So that is a very simple procedure. Where this normal rate would be applicable, what is your rate, slab rate, that is going to be explained in those separate chart what we have made after this. So short-term capital gain provision has been solved. Either it would be 111A or not. If it is 111A, then we have 15% and 20%. If it is other than 111A short term, then whether it's before July, after July, does not matter, going to be taxed at normal rate of tax. This is clear. Short-term capital gain. We have understood that how to tax short-term capital gain. It's too easy to understand now. With the help of those provision, if you learn from this chart, you will understand in 1 minute that what are the tax rate need to be applicable in case of short-term capital gain. Whether before July, after July, no issue. Sorted. If STT not paid on STCG, it would be from your other short-term cap gain part. Clear, Aisha? If these condition does not fulfill, STT not paid, not from recognized stock exchange, not an international financial service center, it would become your other short-term capital gain. So normal rate of tax would be there. Normal rate at what rate? I will tell you, Bhavna, what would be the normal rate. Normal rate would be slab rate, person-wise. If it's a partnership firm, then other short term is going to be taxable at 30%. If it is an individual, then the slab rate is going to be applicable, which is going to be applicable on income from house property, PGBP income, etc. So that is normal rate, okay? Person wise. That will also come in the other charts, relax. Now the long-term capital gain, and you can see the long-term capital gain provisions are also long, very long. Okay. So try to understand these provisions also one by one. So first of all, long-term capital gain is having one capital gain, that is section 112A. So those listed equity shares, units of EOF, etc. If they are having short term, they fall under section 111A. And if they are long term, they will fall under section 112A. No indexation on these long term, and there is taxability if that gain exceeding rupees 1,25,000. So this is two important provision to be understood. If it is exceeding 1,25,000, then how we are going to tax them? So it's say if it is listed in equity shares, STT paid on purchase and transfer both. Short term, on these securities, security transaction tax should be paid on purchase and transfer both case. Then only 112A applicable. Now somebody is asking, sir, if STT not paid on purchase and paid on transfer only, what will happen? That would be other long-term capital gain. It would be taxed then like other long-term capital gain. If no STT paid, it would be taxed as other long-term capital gain. In case of units of equity-oriented fund and business trust, STT needs to be paid on transfer only. For equity share, STT needs to be paid on purchase and transfer both. For units of EOF and business trust, STT need to be paid only on transfer. If it is before 23rd of July, 10%. If it is on or after 23rd of July, 12.5%. Clear? So if your capital asset is a long-term capital gain, which is taxable under section 112A or which fulfills the condition of section 112A, then if this is equity shares on which STT paid on purchase sale both, or if it's units of EOF and business trust unit and STT paid on transfer only, then the tax would be 10% if it is before July, and it would be taxed at 12.5% if it is after July. Suppose if these are long term and transaction in foreign currency, same like this short term, if it is not short term, if these are long term, foreign currency, a recognized stock exchange, in IFSC, no STT paid. So no indexation benefit. Of course, section 112A says no indexation in any case. No indexation, no TTVR provision need to apply. Rate would be exactly same. So you can learn this also as a consolidated provision. That if they are listed equity shares on which STT paid purchase and sale, EOF and business trust, STT paid on transfer. Rate would be 10% or 12.5%, including if the transaction has been in foreign currency and recognized stock exchange in IFSC, then no indexation, no currency fluctuation, rate would be 10% again, and the same is 12.5%. So this is 112A completed. Now we left with section 112 capital gain. Okay. So 111A has been completed, which talks about the short-term capital gain in case of specified securities. Then other short-term cap gain we have discussed. Now in case of long-term, section 112A we have discussed. Again, this is for specified securities or securities in International Financial Service Center. Rate would be 10 or 12.5. Now we have left with other long-term capital gain or other long-term capital asset under section 112. Look, I completely understand that still it's not that easy, but there is no other way. If this is not the way to understand this provision, that every other way, in my opinion, is going to be very complicated. So if you'll go with this diagram once or twice or thrice, you will definitely going to understand all the provision very easily. But you have to revise this diagram at least, because this is the only way I personally feel that this is the only way in which you can understand the provision easily. Otherwise, everything else is going to be very difficult. Okay. So in case of other long-term cap gain, if it is before 23rd July 2024, before, if it is unlisted securities, shares of closely held company, you will find each and every point in the notes also. So if you have any confusion, you can refer the notes. So if the unlisted securities are there or shares of a closely held company, and for non-corporate non-resident, if the assessee is a non-corporate non-resident, like individual non-resident, HUF non-resident, or if it is a foreign company, sorry, the rate of applicability is 10% on these securities without index and no currency fluctuation. You can see till now, we do not have that TTBR concept is over here. There is no capital gain we have seen with TTBR concept till now. In all other cases, without TTBR, etc., without indexation, we are discussing the provision. So if these are unlisted securities or shares of closely held company, and assessee is a non-resident or foreign company, the rate would be 10%. And if assessee is other assessee, that means resident, then the rate would be 20% with indexation benefit on these securities. If it is before 23rd of July. If these are listed security, there is new provision has been come. Listed security or zero coupon bond. If before 23rd of July, you are transferring a long-term capital asset, and that is a listed security or zero coupon bond, then we have to calculate tax twice, 10% without index, 20% with index. And lower is going to be the tax we need to pay. So if these are, you can see the difference between 1 and 2. One is for unlisted security and shares of closely held company. The second is for listed security and zero coupon bond. So in that case, we have to calculate tax once, 10% without indexation and 20% with indexation. Whichever is lower would be my tax liability. Other assets. Other asset will consist building, land, jewelry, etc. All other cases except this unlisted security and listed security and zero coupon bond. All other will fall in third category, and it says 20% with index like land, building, jewelry, etc. If these are long term, clear? So 20% with indexation. Now moving on to the last. Now on or after 23rd of July 24, what would be in case of other long-term capital asset if they have transferred on or after 23rd July 24? In my opinion, it is now easy than before 23rd July 24 provision. This is easy now. It's very simple. In all long-term capital asset, the rate would be 12.5% without indexation. That's it. Except in case of that land and building concept. In that case, we have to find the lower. So if land and building are both, if acquired before 23rd July 24 and transfer on or after 23rd July 24. So we have two options, whether 12.5% in case of individual HUF resident. 12.5% without index or 20% with index, the lower will be the tax. For other assessee, other than individual HUF resident, it would be 12.5% without index. It's a normal case. For other assessee. If land and building are both, if acquired on or after 23rd of July and transfer on or after 23rd July 24 or any other asset. If transfer on or after 23rd July 24. So now we have a very simple provision. That is 12.5% without index. There is no indexation need to be done. In case of non-resident, long-term capital gain. So we are talking about this. In this case, so if this asset, which has been discussed in the first case, in case of non-resident long-term capital gain on unlisted security or share of a closely held company, tax would be 12.5%. Earlier it was 10%. Now it's 12.5% without index and foreign currency fluctuations. In all other cases, it would be 12.5% without index. So that was the provisions in case of taxability. And still, I feel that if after reading all these provisions, there would be a question. And if the question asks you to calculate the tax on certain capital gain, etc. So from a point of view of a individual or an assessee, it would be difficult because suppose if it's a resident, then you have to apply multiple provision. For resident, the concept is different. For non-resident, the concept is different. So it's really important to make diagram from the point of view of question is going to be asked. That how you will charge rate of tax if it is a question of resident or a non-resident before July or after July. So from this chart, we made other two diagrams from the point of view of questions. But before that, we have some certain clarification and that TTBR tax rate provision also in point number 7. If you are feeling where that TTBR concept has been gone, so that need to be separately shown. Before that, resident individual HUF can claim unexhausted basic exemption limit from 112, 112A and 111. So they can take the benefit from basic exemption limit from these income. But non-resident cannot take the benefit of this unexhausted basic exemption limit from section 112, 112A and 111. And again, what is going to be happen? Why I am trying to make you understand the concept from this point of view also and from tax rate point of view also, from person wise also in the following diagrams, because there would be a chapter, that is chapter number 9. That would be the last chapter of your syllabus. That is calculation of total income and tax thereon. So that chapter is again going to be take classes by me, because after income from other sources, other faculty will take, I guess, clubbing provision topic and set off provision and deductions topic. After that, TDS provisions, return filing procedure, and computation of tax and total income. That is going to be taken by me again. So when that chapter will come, chapter number 9, in which we have to calculate tax on each kind of income. So if you want able to understand to apply the tax rate as per question wise or as per person wise, so you won't able to solve that chapter also. You won't be able to understand and to how to solve the question of chapter number 9. So whatever you are studying in this capital gain chapter, remember this is exactly going to be discussed in chapter number 9. So that is going to be repeat again, because the actual questions which has inclusive all kinds of income. This topic is only concerned about the capital gain taxability of income. They have not discussed the other rate of taxes in case of different kinds of person, etc. So chapter 9 will cover each and every kind of income and the tax need to be applicable on them. So again in chapter 9, we need this diagram which I already prepared for the purpose of calculation of total tax as a whole. So that would really help you in chapter 9 also. Okay. So basic exemption limit benefit resident can claim, but basic exemption benefit limit non-resident cannot claim. Bonds and debenture, we have already discussed this point. Bonds and debenture, listed, unlisted is transfer, redeemed, matured before 23rd. Then the gain would be long-term, short-term, depending upon the period of holding, no index. Bonds and debenture, listed, unlisted, if transfer, redeemed on or after this date, they would always be short-term under section 50AA, no indexation still. No reduction can be claimed under section 80C to 80U. We have discussed earlier. No rebate for section 87A against long-term 112A. Now point number 7 is for TTBR provisions. So TTBR is applicable in both cases. If long-term capital gain on listed share other than 112A or debenture of an Indian company acquired in foreign currency. So there was no case in the above diagram in which shares has been acquired in foreign currency. They have been transferred in foreign currency in the different case of IFSC, etc. But there are no case which says they have acquired in foreign currency. So this is separate case I need to include to make you understand. So if there is a case in which there is a shares debenture purchased by only a non-resident in foreign currency. So at the time of transfer, we have to calculate the gain with TTBR, TTSR provisions. So what is the tax rate on that specific kind of provisions? If it is before 23rd of July, 20% tax without index, but with TTBR and TTSR provision. If it is on or after 23rd of July, 12.5% tax without index, but with TTBR and TTSR provision. Let me tell you one more thing. It won't happen that in a single question, examiner will ask you tax for each and every income. That is not going to be possible. Because when there are any provision which is very complicated, so there is a silent benefit also over there that that kind of question generally cannot be asked in examination because we have a limited time. An examiner does not want that for a 5 marks of question, they will take your 30 minutes or like 25 minutes. For a 5 or 10 marks question, they have to ask the total income part also. And they have to calculate you the tax also. So that cannot be a single question which include all these things. There could be section 111A income or 112 or 112A question income part or 112. So that is not possible that each and everything would be in a single question. But we have to learn each provision because anyone can come. So might be there is only one part of capital gain on which you need to calculate the tax. But we do not know which kind of capital gain question could be asked in the examination. Suppose we have discussed all the provision of this chart presentation, but examiner could ask the question for taxability of this also. So we have to understood, we have to learn also this provision that if this section 112 gain, and if the TTBR concept is there, so what is the tax rate in this case? So that is 20% and now it is 12.5%. Without indexation means Tambeshwari saying net worth calculation? No. Without indexation means Tambeshwari, we do not need to do any indexation. Net worth is only in case of slum sale. That is not going to be the part of any other security, etc. case. Okay, Hardik is asking, sir, if listed security, zero coupon bond, 12.5, where when there is a rate 12.5%, there could not be any indexation. Indexation never going to be applicable if there is a rate of 12.5%. Hardik, okay? Now we need to understand these provisions with the help of assessee's point of view. Now let me tell you a very interesting thing. To solve any question of tax calculation, you have to do this. It. So for solving a tax calculation question, suppose there is a question that is before 23rd of July 2024. So if the question belongs to a resident assessee, so you must have given question income in that question. First of all, we have to calculate the gross total income. Suppose the gross total income is having following content, like there's a PGBP income has been given in question like 2 lakh rupees. Income from house property, suppose it's 40,000. Long-term capital gain 112, it's 1 lakh. Long-term capital gain 112A is suppose 50,000. Short-term capital gain 111A is like 40,000. Other short-term capital gain is suppose 60,000. Deduction under section 80C to 80U is suppose 1 lakh. Casual income, what are casual income, etc. That is going to be discussed in detail in income from other source. For the time being, let me tell you, casual incomes are those income those has been earned on the basis of luck, like gambling, betting, online games income, etc. So those income which has been earned casually. So the luck part is more than your effort part. That is called casual income. Fine. So winning from lottery, etc. is a part of that income. Suppose casual income has been given in question is 50,000. So now you need to calculate the tax on it. So you must have calculated the total income also. So if there is a calculation which is required to calculate the total income and the tax, so what you will do, you need to follow this format. The GTI, which has been given in question, need to be divided in 5 parts. The first part is casual income. We have to show it separately because the tax rate is 30% fixed. In case of casual income, the rate of tax is 30%. Right? Then long-term capital gain under section 112A, if that is in question, need to be separately write because the rate is different. Then we have to separately show short-term capital gain under section 111A because the rate of tax is different. Then we having long-term capital gain. And then balance would be the part of others. Now the long-term capital gain could be also having several parts, like if this is listed securities or zero coupon bond. So we are having separate provision. For other long-term capital gain, we are having separate provision. So generally, in my opinion, these listed security or zero coupon bond would not be in the question because that will make the question more complicated. Because then we have to make the two part of this 10% without indexation we have to calculate and 20% with indexation we have to calculate. So that will unnecessarily going to make the question more complicated. So that might not be the point of view of examiner also because they won't make a question which is very, very complicated. So the rate on long-term capital gain under section 112A is 10%. The STCG rate before 23rd of July was 15%. The other long-term capital gain, which is section 112. The other case, the rate of tax is 20%. And these are person-wise. Suppose resident Mr. A, age 49 year. You want to follow optional tax regime. An examiner asks you to calculate the income. So whatever GTI we have to divide that GTI into these 5 parts separately. Like PGBP would be form part of other. Then income from house property would be over here. Long-term capital gain 112. If the question is silent, we will always assume it's other part. Long-term cap gain 112A. It is not necessary this all these should be given in question. Might be only 112 there or only 112A. So 112A is 50,000 up to 1,25,000. It is exempted. So this value would be nil. There would not be any income in this 112A part. Then short-term capital gain 111A is forming part of this 40,000. Other short-term gain would be part of my normal income. Now, casual income is in question 50,000. So we need to divide the income which has been given in question in this diagram. This is the only way to solve this question easily. If you'll try to solve this question vertically, that would be really difficult you to solve. So you have to divide this income into this 5 heads of different rate tax of income. So you will understand what rate need to be applicable on which income. Now the total of other income would be 3 lakh rupees. Deductions also given in question, and the provision was saying that deduction cannot be claimed from this. Even deduction cannot be claimed from casual income also. That is going to be discussed in income from other source. So deductions, any deduction can only be claimed from the part of other income. No deduction can be claimed from these income category. So we have deduction of 1 lakh rupees. So now this is 2 lakh. 2 lakh my other income. 1 lakh is my this, so total is 3 lakh rupees. Now 40,000 is short-term capital gain 111A. That means 3 lakh 40,000 rupees. And then 50,000 is my casual income. So that means 3 lakh 90,000 rupees. So my total income TI would be 3 lakh 90,000 rupees. 2 lakh, 3 lakh 340, and now this would be 390. Clear? Now, if we'll solve this question by applying the rate of taxes, my basic exemption limit would be 2,50,000. Out of this 250, the 2 lakh exemption limit I can claim out of this 2 lakh rupees income. So this income would be 0. Suppose if there would be income, then it's going to be taxed at the slab rate of 2.5 lakh rupees nil. The balance is going to be taxed at the 5%, then 20%, and then 30%, so on. The balance 50,000 we have left, because out of this exemption limit only we utilize 2 lakh rupees exemption limit. The balance 50,000 can be utilized from this income. So that would be remaining 50,000. And the tax rate is 20%. So my tax would be 10,000 on this income. No income in this category. This is going to be taxed at 15% category rate. So that would be 6,000. And the rate on this would be 30%. So that would be 15,000. So you have to separate your income in this format, the format we are going to discuss in the chart. This need to be used like this. Whatever income you have as your GTI, you have to divide that income into this category of income. And the rates, whatever you have, need to apply accordingly. And then the total tax would be there. Rebate provision could be there. The surcharge and the cess would be applicable in this way. This is the only way to solve these kind of question. Again, I am telling you, in a single question, it is not possible that they will give you 112A also, 111A also, other long term also, other income also, casual also. I am just showing those income over here. So that was an example to make you understand how to put income in which category. In the examination, I believe that there could be other income or there could be any one long term or short term, that's it. So examiners want to know that you know the process or you know the tax rates or not. So it does not mean that in a single question they will put all the provision to ask you to solve the tax structure, etc. That is not that easy to solve in examination. So moving on to the chart. Sai Kiran is saying, Kasak is Sai, sir, while filing assessment year 24-25 income tax return 87 exemption is not available when STCG income is there. Yes, that has been changed by the department. So that's what I'm saying. The full rate of taxability provision we are not discussing over here. We are just discussing the rate of tax we need to apply. We are not discussing the rebate concept in detail. We are not discussing the surcharge provision detail. We are not even know the casual income detail provision. So this chart is just trying to make you understand that how to divide your income. The rebate would be applicable in which case, how to calculate complete tax also, TDS need to be deducted, advance tax need to be deducted, interest under section 234 ABC need to be calculated. So there are multiple provision left. which will be discussed in chapter number 9, Mr. Sai Kiran. So these kind of provision we will discuss in chapter number 9. For the time being, this chapter is just trying to explain you the rates of tax we need to apply in case of capital gain. And because capital gain is a very complicated rate structure provision, so with this capital gain, I also prepared the chart in which other incomes also included. So in this chapter, I'm just trying to explain you that if you're having separate kinds of income, you need to put those income in a specific format to find out the correct tax liability. We are not right now in a situation to calculate the correct tax liability because multiple provisions will come later in other chapter also. Then we will be able to calculate the tax. Kassak is saying, sir, 50,000 of BEL can be deducted from long-term capital gain or short-term capital loss, STCL. Why are you writing STCL? How can we claim basic exemption limit from loss? The format what we have used is like this, that first of all, the format we have made is like this. First of all, you use the basic exemption limit from others, then transfer it to long-term cap gain, second number, then short-term cap gain 111A, then long-term capital gain 112A, and then in the last casual income. But casual income cannot claim the basic exemption limit because it is fixed taxable. You cannot use the basic exemption limit against casual income. So this format has been prepared like this, that the basic exemption limit should derive from like this: one, then second, then third, then fourth. You have to provide the basic exemption benefit in this scenario. Okay, Kasak? Okay, so now you can see how to apply the rate. So first of all, you need to divide your gross total income in the following case. So if it is before 23rd of July, then if you are a resident, then you have to divide your GTI into other long-term capital gain, 111A, 112A, and casual. If there is any casual income, that part need to be shown in this category. This is going to be taxed at 30% fixed. If there is any long-term capital gain under 112A, the rate is 10%. You cannot claim the rebate out of it. If that is short-term capital gain 111A, then the rate is 15%. If that is other long-term cap gain, that means section 112, others, then it will be divided into two categories. If it is listed security or zero coupon bond, the tax would be like 10% without index, 20% without index. In my opinion, in any question, I preferably think that this would not be given in the question because that will make your question more complicated. But if it is in the question, we should know the solution part. If there is any other long-term capital gain, in this scenario, the rate would be 20%. If any other income except these four would form part of your other income, deduction can be utilized out of this income and slab rate is going to be applicable. If that is a non-resident, the basic exemption limit can only be utilized. Okay, I guess. Deductions would be from other income only. Clear? So if that is a non-resident, then we are having casual income, then long-term capital gain 112A, then 111A, then long-term, and then other. Deductions would be again from other income only, as in normal case. Slab rate person-wise applicable. But the story is this: you cannot claim the exemption limit from long-term capital gain. This is again fixed taxable, like casual income. The basic exemption could be used by a resident only from other, then long-term, then short-term, then long-term. But if you are a non-resident, first of all, you cannot claim any rebate from any case. If you are a non-resident, and only basic exemption limit can be utilized only against other income. You cannot utilize the basic exemption limit from any other income in case of non-resident. Again, if you are a non-resident, you can see as per the diagram, the capital gain would be so complicated. The long-term capital gain could be unlisted security share of a closely held company. 10% without index and without fluctuations need to be taxable. If these are listed security or zero coupon bond, then the same benefit would be here, 10% without index, 20% without index. In my opinion, this would not be an examination. This will also not be an examination. Listed security in debenture of Indian company purchased in foreign currency, that TTBR, TTSR, because that was the case for non-resident. So this concept would not come in case resident concept, that will only come in the case of non-resident. So if that is 20% without index with TTBR provision, for other long term, the rate would be 20% with index. For separate incomes, that would be slab rate. So we will discuss this diagram again in chapter number 9. So from a point of view of an assessee, from the point of view of a question, when there is income, you have to divide that income in this different categories of income. And the rate is whatever is written over here has been came from the above diagram. Again, the clarification is there. Resident claim the basic exemption of 2.5, 3 or 5 lakh from other income first, then long term, then short term, then long term double 2A only. Non-resident can claim exemption of 2.5 lakh from other income only. Tax need to calculate in the most beneficial manner. So that was a case before 23rd of July. What is the case on or after 23rd of July? That we will discuss after a small tea break. And then we will solve our MCQ and test your knowledge question. So when we will solve some test your knowledge question, you might be able to understand that exactly how to apply the rates, etc. So Mr. Nisa, can we go for a short break? Bhavna is asking, so what is the difference between resident and non-resident tax rate? The resident can claim the basic exemption limit of 2.5 lakh. And they can transfer the basic exemption limit of 2.5, 3 or 5 to other category of income also, like long term, etc. But non-resident cannot do those. In case of non-resident, you cannot claim the rebate from any income. But in case of resident, you can claim the rebate also. So there is a lot of difference, Bhavna. And if you want to understand the difference between the resident and non-resident tax structure, you should read the basic chapter, basic concept chapter number 1. You should watch the classes of that in which we have described in detail what was the rate differences in case of a resident and a non-resident. So Mr. Nisa, can we go for a break? सर ब्रेक करना है ना उस ब्रेक ओके निसर्ग जी कंटिन्यू करें? Okay. Okay, welcome back everyone. So we were discussing the provision of capital gain. I guess you must have need a lot of energy to understand all these things. And once again, let me tell you, as I always say, that numerical topics looks very difficult until we practice those topics. So I have tried the past year questions also. I have seen the MTP question, RTP questions, and your study material questions also. So do not worry, that question would not be that much difficult that you have to apply all the tax rates in a single question. And generally what happens, the question asks the major rate of taxes which need to be applicable. So that IFSC, the International Financial Service Center rates provisions, the zero coupon bond provision, 10%, 20%, these are very specific rates of tax procedure. So in my opinion, that would not be going to be asked in a single question. There could be a separate question for 2 or 3 marks for calculation of tax on zero coupon bonds, for calculation of tax on TTBR provision. So you would be really easy to solve those provisions if you remember the charts. But in a single question, there would not be zero coupon bond, long term 112A, 111A, normal long term 112, short term normal, casual income, rates of tax. That would not be in a single question. I have gone through with all the question last 5, 6 years, 7 years of income tax question paper and MTP, RTP also. So just try to remember the provision with the help of diagram. So when there is a question of 2 marks or 3 marks, from International Finance Service Center or TTBR provision, etc. So you must have remember those provision to apply and to calculate the tax. But for that single question, do not think too much that that is going to be that much complicated in your examination. So we were discussing the rate of tax, and that was the before 23rd of July provision, and this chart is on or after 23rd of July 2024. Almost same provisions, more simplified, I guess. You can see the gross total income, casual rate. F stand for fixed. Whenever there is F in a rate, that means you cannot use the basic exemption limit in this case. So again, the 112A would be 12.5% with no rebate. 111A now rating 20%. Long term other, land and building or both. So if you are an individual HUF and resident, 20% with index, 12.5% without index, the lower would be taxable value. Others, resident, assessee, 12.5% without index. Why only other resident? Because if you are a non-resident, then these provision would be applicable. Other long term, it's only 12.5% without index. So you can see after 23rd of July 24, on or after, the rate structure has been simplified. If you will see the diagram for before 23rd of July, you can see this, how much complicated. And on or after 23rd of July, it is slightly easy. So for non-resident, it's 30%. Long-term 112 at 12.5% fixed. STCA fixed. Other also fixed. So now if unlisted shares security of a closely held company, 12.5% without index, without currency fluctuation. Listed shares and debenture in an Indian company, foreign currency, 12.5% with TTBR concept. Other long term is 12.5%. So you can see this is slightly easy. What was before 23rd of July provision was there. So you have to go through this diagram rate structure. You have to understand only one thing, that if there is a question, which income I need to put where to find out the taxability of the rates. So now we are going to discuss the MCQs. And if there is any query, let me see. No query yet. Of course, the story would be possible if we would have some time, because we need to complete the MCQ part and then we will have a test your knowledge questions also. So MCQ part will also help you to understand the applicability or how to calculate the tax rates. So let's move. Exemption under section 54F is available to all assessee, to individuals only, individual as well as the HUF. The correct answer is of course C. A simple question, so we are going to solve it. Correct option is C. Next is the exemption section 54F shall be available. Point number 2. What should be the correct answer? Proportionate to the net sale consideration. That original capital gain upon net sale consideration. So that is the proportionate to the net consideration price of investment. Now total income for the assessment year 24-25, that should be, sorry, previous year. 25-26 of a non-resident individual, including long-term capital gain of building rupees 90,000 before 23rd of July 24 is rupees 3 lakh rupees. So the tax on total income shall be apply optional tax regime. So this kind of 2 marks question could be asked in examination for the purpose of rate calculation. So we need to divide the income into 5 category. We do not have any casual income in the question. We are having income total is 3 lakh rupees, out of which 90,000 is for building. So that means 2,10,000 was other income, and building will be fall under 112 other long-term capital gain. So that is 90,000. Now we need to calculate the tax. So what would be the correct answer in this case? Let's see. Question number 3, Hardik is saying B. Okay. Anyone else? Kasak is saying B. Well done. Niru is saying B. Muskan is also saying B. Very well done. Tambeshwari is saying, I was telling you that the solutions are not that difficult. When we read the provision, we find it out very difficult, very complicated. But when there will be practical question in front of you, you might not feel that that provisions were that complicated or difficult. Abhishek is also saying B. Dilip is also, everyone is giving the answer B till now. Okay, Sania is saying A. B Saikin is also saying A. So except these two persons, Sania and B Saikiran, everybody is saying the correct answer is B. And the correct answer is A, not B. Vishmita is also saying A. The correct answer is A. When we talk about the tax means including tax, surcharge, cess, everything. So those answering only B. Technically, they are, look, 210,000 with the basic exemption limit. The remaining exemption limit cannot be transferred to 112 because it's a case of non-resident. Clear? So that is going to be taxed with a rate of 20%. Tax would be 18,000. No rebate would be here because this is non-resident case. No surcharge because TI not exceeding 50 lakh. But why you left cess 4%? Cess is also a part of tax. What are you doing, students? The correct answer is not B. Its correct answer is A in this case. So the correct answer would be A, not B. Only 3 students give the correct answer. Everybody else was saying B, B, B. Please think about it. When we ask calculation of tax, it always means applying the rebate concept, surcharge, cess, everything. Final tax liability. Next. Question number 4. Total income of a resident individual age 58 years, including long-term capital gain of building rupees 40,000 on or after 23rd of July, before 23rd of July, of course, case. Where is before? 260. Tax on total income shall be apply optional tax regime. How much should be the tax in this case? Now let's see what is the correct option. This Surya is saying D. San is also saying D. Okay. Anyone else? Karan, Pallavi. Okay. First of all, so total income was 260, including this building gains. So without this building gain, it is 2,20,000. Clear? And the gain of building is 40,000. So it's a case of resident. So in case of resident, there is 2,50,000 basic exemption limit, out of which 220 has been utilized over here. Balance left 30,000. So this is going to be 10,000. Now you students forgot about the rebate provision. That's why you are answering 2080. Now the tax on this is 20%. That is 2,000. But the rebate concept was there, and it was saying that if your total income of a resident is up to 5 lakh rupees, TI is up to 5 lakh rupees, then you can claim a rebate of 12,500 rupees or the amount of tax, whichever is lower. So in this case, rebate would be applicable. So rebate would be 2,000. Tax liability would be nil. It should be correct answer is B, not D. What are you doing, students? It's a resident question. So in the previous question, we did not utilize the rebate because that was a non-resident question. This is a rebate provision applicability because TI up to 5 lakhs. So we will provide rebate to a resident individual up to 12,500. But tax is only 2,000. So rebate would be 2,000 and tax liability would be nil. Yes, I guess now you won't forget, Ajay. Okay, next is long-term capital gain before 23rd of July 24 on sale of listed equity shares and units of an equal-oriented fund. It would be equity-oriented fund shall be taxable at the rate of 10% without indexation, taxable at the rate of 10% without indexation, provided exceed 125, taxable at the rate of 15%, or exempt if sold through a recognized stock exchange in India. What should be the correct answer? देखो भाई जब भी क्वेश्चन आएगा ना टैक्स कैलकुलेशन का तो रिमेंबर टैक्स रिबेट सरचार्ज और सेस इन चारों के प्रोविजन यू हैव टू रिवाइज बिफोर गिविंग योर फाइनल आंसर whenever you calculate tax then think about rebate that whether it's applicability or not, resident, non-resident, is it applicability or not? If no or yes, then proceed for surcharge. If income exceeding 50 lakh, 1 crore, etc. And after that, you'll come to the cess provision. Then only you can tell your final answer without thinking about these provisions. If you are skipping the provision, you might be able to find the wrong answer. So the correct answer is option number B. There is exemption of 1,25,000 in India now. So this is the correct answer, option number B. Next is, if certain conditions are satisfied, question number 6. Let me tell you the correct answer. It's very simple. 2 crore rupees. You can go through this question later. Ram acquired land from Ravan Limited as on 15/12/2008 for rupees 8 lakh, which was sold on 15th May 24 for 21 lakh 50,000. Expense transfer were 20,000. He invests 3 lakh rupees in the bonds of Rural Electrification Corporation Limited on 16/12/2024. That is section 54 EC. You need to calculate the capital gain in question number 7. So we have short of time, so I'm going to solve it myself. Assessment year 25-26. The sale consideration was 21.50 less expense on transfer was 20,000. So net sale consideration is 213,000. Now the purchase consideration was 8 lakh. multiplied by 363 divided by 137. So my cost of acquisition, that means index cost of acquisition, would be this much. And the gain would be 10292. So because the investment has been made after 6 months from the date of transfer, so this 54EC exemption does not applicable. So the correct answer is option number A. Next, Ram purchased a plot of land in Agra for rupees 15 lakh on 5th July 2004. The land was sold on 5/6/2024 for 75 lakh rupees. Compute the capital gain on sale of house if he invested 20 lakh rupees to purchase new agricultural land in rural area before the due date of ROI. So again, let me solve it for you. The sale consideration is 75 lakh less index cost of acquisition is 15 lakh into 363 upon 113. So that would be 4818584. 2681416, and we invest 20 lakh rupees for purchase of we invest 25 lakh rupees. So we invest 25 lakh rupees. So the gain would be 181416. Good. Next is Mr. X has sold his land for a consideration of 25 lakh rupees. So the sale consideration is 25 lakh rupees to Mr. Y, who has paid a stamp duty of 3 lakh, that is 10% of stamp value. That means stamp duty value is 30 lakh rupees. Now we need to find out the sale consideration as per section 50C. So the provisions say if the SDV exceeding 110% of consideration, then SDV will be the sale consideration. So the stamp duty value, now the sale consideration as explained by the SSC is 25 lakh. So 110% of this would be 27 lakh 50,000. So stamp duty value is 30 lakh, which is in excess of 110% of consideration. So in this case, sale consideration would be equivalent to stamp duty value. That means 30 lakh rupees. Option B is the correct. Mr. Chandan, age 70, received 30,000 per month from the financial year 25 under a reversed mortgage scheme. So he needs to know that whether this 30,000 per month is going to be taxable or not. The correct answer is nil, because under reverse mortgage scheme, whatever we receive monthly, etc., that cannot be the part of my income. That would be a liability which cannot be treated as an income under Income Tax Act. So those were the MCQ we discussed. Now let's discuss some question, that is part 1. It would be test your knowledge question. I solve all the test knowledge questions I want to see which is more relevant for all of you. This question number 1 is good. Can solve question number 1. Test your knowledge question number 1, which is for regarding conversion of shares or debenture into the shares. So we have discussed in section 47, there was a concept which says conversion of debentures into the equity shares would not be treated as transfer, or those provision needs to be taxed in the year when we transfer those assets in the future. So the conversion is not going to be treated as transfer, whether it's debentures or shares of the same company. So the question is regarding that provision, and it says Mr. Mithun purchased, you can see 100 equity shares of Messrs. Good Money Company Limited on 1st 4/2007 at the rate of 1,000 per share in public issue of the company by paying security transaction tax. Okay. Company allotted bonus share in the ratio of 1:1. On 1/12/2023, he has also received dividend of 10 rupees per share on 1st May 2024. So now there is not a conversion question. He purchased equity shares, and against those equity shares, he also received some bonus shares. All the bonus shares and equity shares has been transferred on 1st October 2024 at the rate of 4,000 per share through a recognized exchange and paid brokerage of 1% and STT of 0.02%. Compute his total income and tax liability if Mr. Mithun pays tax under default tax regime, assuming that he is having other income of rupees 8 lakh rupees. Fair market value of shares of Messrs. So and so was 2,000 on 31st January 2018. So that is section 112A concept which we are going to solve one by one. So you can see in question number 1, there was equity shares, number was 100 at the rate of 1,000 we purchased, against which the total value of these shares was 1 lakh, and that has been purchased on 1st April 2007. Again, these shares, bonus shares also allotted in 1:1. So 100 bonus shares, we did not pay anything for it, so the cost would be 0. That has been allotted on 1st December 2023. Now all shares has been transferred. The sale consideration would be 4,000 each. You can see one security is long term, and this is going to be short term because the transfer has been made on 1st October 2024. So these are short term and these are long term. Now we have to calculate the capital gain, original shares and bonus shares. These are long term, these are short term. First of all, the sale consideration, that is going to be 4 lakh in both cases. Less expense on transfer, that is 1% brokerage was there, I guess. That would be 4,000. That would be 4,000. So 396. 396. Now let's cost of acquisition because indexation would not be applicable in this case, and cost of acquisition for these long-term capital asset as per section 112A. So we have to compare it with the fair market value and the sale consideration first. The lower will be selected and that is going to be compared with the actual price, and the higher would be my cost of acquisition. So the FMV was 2 lakh. It was 2,000 per share, so it would be 2 lakh. And the sale consideration in question is 4 lakh. So lower would be 2 lakh. And the actual purchase price, the cost was 1 lakh of these shares. So higher would be 2 lakh. So that would be my cost of acquisition. The long-term capital gain would be 1,96,000. And there would not be any cost for bonus shares. So it would be 3,96,000. The dividend income also in the question is, that would be 2,000. And the other income in the question says it would be 8 lakh rupees. So now the question also asks us to calculate the tax on this case, and the tax would be calculated as per default tax regime. We need to calculate the tax. So how we need to calculate the tax, I have shown you the chart. Then whenever you have all kinds of income in the question, you have to divide those into 5 parts. So first, then we have 8 lakh rupees. That is also part of other income. So total other income category part is 8 lakh 2,000. Then we are having STCA under section 111A, which is this. That is 3,96,000. And as the transaction has been taking place on or after 23rd of July, that is on transaction is on 1st October 2024. That is going to be taxed at the rate of 20%, you can see. And we are having 112A long-term capital gain also there. And out of this 1,96,000, 1,25,000 would be exempted as per the exemption we are having. So 71,000 is going to be taxable at the rate of 12.5%. So as per slab rate, we need to calculate tax on this. And as per slab rate, my tax would be 30,200. Like first 3 lakh exempt, then for next 4 lakh, then for next 3 lakh sort of. So that would be 5%, 20,000. And that would be 4, 5, 6, 7. So balance would be 1,02,000. The rate would be 10%, 10,200. So tax would be 30,200 in this case. Then we have STCA is 20%. That would be 3,96,000 into 20%, 79,200. And then the tax on this value would be 8,875. So total tax would be 1,1,8 275. So either rebate would be applicable? No. Rebate is up to rupees 7 lakh. No rebate would be in this case. Surcharge applicable? No. 4% cess would be there, and that would be 4731. So after that, my final tax liability would be 123006, and rounded off would be 123010. So that would be the final tax liability in this case. So you can see this is the kind of question which can be asked in the exam 5 or 6 marks. So we need to calculate the tax, the income also, and the tax calculation also. And as we have seen the diagram, you can see how easy to calculate the tax. If we know that where to put which income and which rate is applicable on it. So the tax calculation is just a mathematical calculation. There's nothing to do with the income tax provision. We just income taxes end when you put all these things over here. After that, it's a kind of a machine which will calculate your tax automatically. Of course, you have to remember that surcharge, rebate, this exemption of 1,25,000 need to be applicable. But there is no as such difficult calculation if you are able to put the correct income at the correct place. I hope you understood. There are more some test your knowledge questions in your study material also, and the solution has been given in the questions. So like this is question number 2. RF convert his plot of land purchased in July 2004, 80,000 into stock in trade. So that is section 45 to applicability. The fair market value is 3 lakh. This stock has been sold for 3,25,000. So calculate the PGBP income and the capital gain also. So PGP would be 25,000 because sale price and purchase price is 25,000 is my PGBP income. And capital gain also very easy. This would be your sale consideration. Assessment year would be 25-26. Chargeability year would be 25-26. But the transfer year would be the conversion date. That is 31st March 24. Sale consideration would be 3 lakh. Then the index cost of acquisition 80,000 was purchased, but because the transfer has been done on 31st March 24. So index would be previous year 23-24 financial year need to be taken, which is 348. And so that forfeiture will reduce the cost of the asset at the time of transfer. And one forfeiture amount is on or after 2014. So that is going to be your income from other sources also. So that is a very interesting question, but again, not for tax calculation, etc. You just need to understand the question first. We have the detailed solution of each and every question which has been beautifully drafted in the study material. So you can go through with this question. If you have any problem in test your knowledge question, let me know. I will solve in the next session, which is for income from other sources. That would be day after tomorrow. If you have any query, students, you can ask. Kastak is asking, sir, how to present the solution because the solution is study material has given the provision along. Study material provide the provision with the solution so anyone can understand that why it is happening, why we are taking this value as a cost of acquisition. For your solution purpose, you have to write it down the heading part, that computation of cap gain in the hands of assessee. I have explained it. I guess in the class session number 2, I have explained that from the point of view of examiner, I need to see the computation heading, who is the assessee, what is the assessment year. Then I want to know the period of holding, you have to show the period of holding. Then the sale consideration, the net sale consideration, the index cost of acquisition, how you calculate the cost of acquisition and cost of improvement. That's it. Not that detail which has been shown in the study material, because they are trying to teach you each and everything in detail. So that is the solution for only to make you understand. So once construction completed for unsold flats, also we have to pay capital gain tax? No, until you will transfer those property, you need not to pay any capital gain, etc. And once construction has been completed, that would not be your capital gain, that would be your stock in trade. And until otherwise that stock in trade has been sold, you would not liable to pay any capital gain tax. Sir, can we solve the question with diagram? Yeah, the tax calculation part you can also solve with the diagram also, but that should be accurately presented and in detail also. So the examiner could see that what tax rate you have applied in which case of capital gain. So it would not be like this, you are putting the value and just solving it. You have to write down long-term cap gain, 111A, 112A, 112, the rate behind it, and then solution. So it should be presentable, and from a point of view of examiner or some other person should understand that what kind of income you have put in which part of the diagram. Hardik is saying in question number 8 of MCQ, we have transferred residential house and purchased agricultural land. Let's see. Ram purchased a plot of land in Agra. The land was sold on this one. Compute the capital gain on the sale of house. Okay, fine. Yes, no, it should be land, of course. Correct. Hardik, you are absolutely correct. Okay. Clear? So, is there any query story? We don't have time for study today, students. So, the story is going to be carry forward to the next session. Okay. We will discuss a story with all of you in the next session. Is there any more query? Kindly ask. I will upload the notes, complete notes, part one, part two with all the diagram, chart, etc. So kindly download that, and you can go through with part one, part two from the single notes uploaded sheet. And please revise those diagram or chart once or twice. You will find it out very easy. They are not difficult because we do not have much questions for tax calculation in this chapter. So we not able to do the practice, etc. But when we will solve those kind of question in chapter number 9, you will feel that this diagram is the will really helpful to solve the question, to understand the question, and how to present the solution also. So the horizontal solution part is the only way to solve tax calculation question very easily. And when you will go through with the provisions of deductions, etc. So this chart also uh, make this sure that you won't be able to solve the deduction wrongly. How it will happen, you will see after reductions topic when we will see each other in chapter number 9 classes. So if there's no more query, okay, you're welcome. So Mr. Nisar, can we close the session? निसर जी फिर चले गए. निसर जी सेशन हो जाएगा, कंक्लूड हो गया मतलब, एक्चुअली आप बंद कर लीजिए.